This is Coach Matt from Tackle Trading, and I just wanted to record a video based on the initial reaction that the market has had to the interest rate hike that Jerome Powell and the Fed just announced. It was expected that we were going to see a rate hike coming into this December 19th meeting. The Fed Fund futures had it projected right around 72% of a rate hike. So the question, really, in my estimation, wasn't whether or not we were going to get a rate hike or not. I always expected we were going to get a rate hike. The question was, what were they going to do with the guidance for 2019? And what was interesting is that the market is not prepared for interest rate hikes in 2019. The market is only expecting maybe one interest rate hike in 2019, given the recent volatility in the stock market. But as Jay Powell has constantly stated in his speeches, that regarding Fed policy, it's not just the stock market that they're going to look at. They're going to look at inflation. They're going to look at maximizing employment. They're going to look at wages. They're going to look at other key economic indicators like retail sales and manufacturing data and housing data. And there's like 32 different points of data that the Fed kind of looks at in justifying what their interest rate is going to be. And regardless of what a lot of people think about the stock market isn't necessarily the only thing that the Fed is looking at regarding that interest rate policies. So when they announced that they were going to lower their guidance down to 2 from the expected 3 that a lot of people were expecting in the market, that even though they lowered their guidance, that just wasn't enough for what the market was kind of hoping for or begging for or wishing for or praying for or begging for. And so because of that, the market's going to sell off in that condition. And that's exactly what we saw here. We saw the market basically give up the hope that interest rates weren't going to start continuing to tighten, that they were going to start maybe stabilizing the interest rate right where it was at 2 to 2.25%, and that's just simply not what happened. But the point of this video is not to discuss Fed policy and whether or not they did correct by the market and correct by the economy. The Fed is a non-political organization that is supposed to have a dual mandate of maximizing employment and controlling inflation. And with inflation right around 2 to 2.5% and maximized employment with manufacturing data where it is, given outside the trade wars and the uncertainty of trade wars, the economy certainly could support a 0.25 basis point increase in my estimation. So I'm not here to really kind of debate that or talk about that. I just want to show you how the market responds to these major announcements, so in the future you can prepare for that a little bit better as well. As you can see right here, this is kind of the market we're seeing at the S&P 500. You're looking at the daily candle, but before we look at that, let's just kind of look at the overall support levels that are very important to the market recently. First and foremost, you had that support level of 2600 to 2625 right here. Once that's punctured, the most logical destination for the market is to go back down into these historical support levels right there at about 2530. And I put that on Twitter earlier today before the Fed even came out. Watch how the market's going to respond at these support levels, because the one thing that has been really working in this market is when the market does in fact break a major support level, like it did, when it broke 2700, like it did when it broke 2600, and now we're coming back down into that ultimate 2530, and obviously it broke that today. If you look at this from an intraday perspective, and I'm going to lower this to a 1-minute chart just to kind of show you kind of the volatility coming into a Fed announcement. So you're looking at this 1-minute chart, and it looks like a big trend, but that's just the scale of it. In terms of this, one technique I was taught a very long time ago on these types of events was to do what's called a K trade, where you put an order above the intraday resistance and you put an order below intraday support levels, and you say, okay, whichever one that breaks on the announcement, trade that break. Well, after getting whipsawed numerous times over my career, I've found that trading the secondary reaction to the event is much better, because it takes out the high frequency trading systems and the volatility, and you can really get a better feel for the overall intraday action in the market. And as you can see, if people were trying to do that today, they get whipped in and then whipped right back out. That's when I talk about waiting a little bit for that secondary response. So I'm going to take this out to a 5-minute chart very quickly to show you that secondary response. So here's the market activity before the Fed. right after the Fed, you see that type of response here. And for traders, they might be like, oh, I should have shorted it here, but no, you got to wait for the better setup. And then it kind of comes into that little bit of a bearish retracement, coming back up into that resistance channel. That is that secondary movement you might be looking for at about 30 minutes after the actual event. And so as that comes up, back up into the resistance channel, then you start to see some pretty good triggers there. So let me just kind of look at this. So as you can see, here's the announcement. Here's the initial reaction. Here's the retracement, slowing momentum at that old support level, new resistance, downward movement in price. That's the trigger. And if you miss that, then you got to look at the old support levels, right? 1530, coming back out to that daily chart here. Look at that 1530 mark right here. That 1530 mark, and I'm going to draw just a little bit of a support zone right there. So let's drop this back down into the 5-minute number. And that you can see it as it's coming down into that support channel right there at 1530. You see it slow down, and let's just kind of highlight that movement here. You see it slow down, and you're patient, and you wait, and then it breaks that 1530 level and goes to the next target at 2500. And then, as you can see, that's after Jerome Powell, and the market's kind of settled down after that. But that I wanted to just show you the instant market reaction in that capacity from a day trading perspective. However, from an investor perspective, I would be very, very concerned. And the reason I would be very, very concerned is that there's a couple things playing geopolitically, and this is one of the reasons why a lot of people in the markets wanted the central bank to stop tightening on the interest rate, is because all of 2018 we've seen rapid volatility, uncertainty, slowing momentum, but for the first time in multiple different years, you're seeing major support levels getting broken on the S&P 500. You have slowing momentum. You have a breaking of support on the weekly chart. That is very, very concerning. Now, keep an eye on how the market's going to respond at 2,500. That certainly could play a significant whole number for it. But in my estimation, there is a tremendous amount of uncertainty here. And given the fact that the Fed has indicated that they're still going to raise, or projected they're still going to raise 2 more times coming into next year, followed by the 4 it's had in 2018, in that environment, if there was nothing going on out there, that's perfectly fine for the stock market. If there's no trade wars, if there's no Brexit situation, if there's no European debt crisis, if there's none of these geopolitical macro type situations, that's fine. But we are dealing with an environment where we have slowing momentum. We have every projection out there is 2019 is going to see slowing growth in corporate earnings, corporate revenues, GDP. You're looking at slowing growth environment around the global marketplace as well. And so given the fact that we are concerned about a lot of those uncertainties, and the Fed is still raising into that environment, tells me that the Fed is looking at this as a non-stock market thing. Now, that is very important, because over the last 10 years, especially before Jay Powell became the central bank president, it was Janet Yellen and it was Ben Bernanke, and every single time we saw market volatility to the downside, whether that was in 2010, obviously the big ones in 2008 and 2009, but even when the market was recovering in 2010, a 10% drop in the market. And I'll kind of show you to this on the weekly chart, but let me take a little bit more time frame here so we can kind of show you what's going to happen, so we can kind of see it. Right here, the market dips, just 10% dip. Okay, just a normal correction. What did the Fed do? The Fed came out with quantitative easing 2. The market then starts dipping. Quantitative easing 2 starts ending in the summer of 2011. And as the market volatility, 18% to the downside, what did the Fed do? Well, the Fed at that point injected, the dollar swap and Operation Twist. And then later on in the fall and early winter of 2011, they announced quantitative easing. And as you can see, it just drives the market. And throughout this entire movement from 29 throughout 2015, the Fed was historically accommodating, and especially in the face of any market volatility. It wasn't up until Jay Powell here where the Fed stopped doing that accommodating language, and even removing that language in multiple policy statements over the course of 2018. And then in the face of all of this uncertainty, political, the Fed still raises rates and still indicates two more coming into next year. That is extremely concerning for the actual stock market, not necessarily for the economy as a whole, but for the stock market. This could be a situation and scenario where we look back and we say, this was the beginning of that next financial crisis. Now, I don't think we're there yet, but we are seeing the beginnings of that. And I do believe that all the traders, especially the tackle traders out there, is caution. The word of the day is caution. Do not be going out picking up stocks as they're falling down and they're getting crushed. Wait for them to drop. Wait for momentum to slow down. Wait for better technical signals for them to shape up. For the bears out there, they got to be celebrating the last couple weeks in the market after getting beat up for the last 10 years, no doubt about that. So let's let the bears have their day for today. And if this market does continue to show pressure and break 2,500, you should see prices continuing to move down in the short term. I think the best way to play this right now is from a slightly bearish perspective, especially if 2,500 is broken. There's a lot of good trades out there, shorting trades out there, but for me, long-term investors, you should be buying insurance on your portfolios, perhaps going to some degree of cash position, unwinding some of those long-term investments, maybe doing more covered calls, add protection to the portfolio, because we're in an environment that is extremely, extremely uncertain. Day traders, keep killing it out there. No doubt about that. Been loving this day trading environment. However, the last thing I want to kind of look at here is the relationship on the dollar. Now, as you can see, let's drop this into that 15-minute chart here. Now, the dollar, as you can see in the initial last few days, just the last few days, here's the dollar. Very consistent bearish downtrend, threatening to break some daily support channels. But if the Fed indicates that they're going to increase interest rates more than the market does, what do we expect the dollar to do? We expect the dollar to do just this. And the trade that when I'm looking at trading the dollar, usually I'm trading it against the euro. And if you look at this, I loved this setup today. And this is the type of setup you're kind of looking for. Some type of very short consolidation setup. The initial movement slows down, continues down. That's what you're kind of looking at. And when you're looking at it from a dollar index perspective, let's see if this is going to change the ultimate trend. Well, obviously nothing today changes this trend. Nothing today changes that trend in any capacity. However, if we are going to go through two more interest rate environments and the dollar does break out of this resistance level right there at 97.70, that is a good technical trigger on the dollar above that 70.70 barrier. So track that 70.70 barrier from an overall trend perspective, because if it breaks that, more than likely you're going to start a new bullish uptrend. Right now, I am neutral on the dollar, given the fact that we're basically neutral between 96.5 and 97.70 over the last month. Keep an eye on that on the top side. On the bottom side, keep an eye on 96.40. So that's kind of your range that you're kind of looking at in terms of, and don't chase the dollar while it's in this range from a swing trading perspective. Always kind of wait till it breaks out of those ranges. But overall, dollar goes up. What do we know with gold? Gold comes back down a little bit, and that's what we saw here. Gold coming back down. Now, gold, I still like it, and if you look at this from an overall retracement, I still like a break of 1257 with perhaps a close above 1260. So keep an eye on that. If the dollar doesn't break 1270, that could be something to see gold continue to move up in that environment. But once again, keep an eye on how it performs at 1256 to 1260. I just want to do a quick video for the tackle traders out there to show you kind of what happened with the Fed announcement today. Market going down, dollar going up, gold slightly down only 0.57%, and crude up just slightly here. So this is Coach Matt from Tackle Trading. Hope you guys enjoyed and survived Fed Day. This was one of the most uncertain Fed announcements that we have seen in recent history, and as such, whenever you go into those environments, always be cautious and wait to see the initial reaction, that secondary reaction, and then let's see how the market responds coming into the next couple days.